Oh, it's official, the countdown has hit 0. We get to start our program. A very warm welcome to you all to the Blockchain Hub Davos 2022. The first edition of the Blockchain Hub on behalf of both Casper Labs and CV Labs, and of course Casper Association and Casper Network and CVVC, and all of the above. I would like to extend a very warm welcome to the Blockchain Hub on everyone's behalf. We'll get some logistics stuff out of the way just for the lovely audience that is joining in person and for the guys that are tuning in online. So you guys all know the way that the program works. We have different blocks centered around different themes that will be unleashing on you over the course of this afternoon. It'll be split up into 60 minutes of content, and then you'll have an hour to network. So we know the main reason people come to Davos is, of course, to make connections, benefit from all of the people that gather in this wonderful place. And we want to make sure that you have ample opportunity to do that. So it'll be 60 minutes of content followed by 60 minutes of networking throughout the day in succession until 8 p.m. But every rule has an exception, and we're starting with the exception. So this particular block is actually an hour and 15 minutes instead of an hour, but I promise it's worth every second of your time. We're starting things off with blockchain meets capital markets. And our first speaker is Dr. Willi Brammertz. He is the president of Nucleus Finance and a staunch advocate for the advancement of financial transparency, inclusion, and efficiency. And he has over 30 years of risk consulting experience for banking, financial services, asset management, and insurance. And he is treating us to a wonderful keynote about ushering in a new era of finance, how smart financial contracts and blockchain can increase efficiency and information inflow. Please join me in giving a very warm welcome to Dr. Willi Brammertz.
Thank you very much. I have to read it. If I don't read it, it will take 15 minutes. So how can we usher in the new era of finance? Before, now it went too fast. Okay. So before coming to the solution, we must understand the problem. What you see here is a model of a bank, actually Rabobank. They did it themselves. It's on the internet. Time does not allow you to explain you everything, every detail in the model. The model looks from below like that. And it's actually a simplified case. It's a simplified version of reality. So what can we derive from that picture? What we derive is that finance is in an utter chaotic state. And we have to be very careful that blockchain makes it not even chaotic in square. So that's what we're talking here. So each spaghetti which you see here is something which is normally called a data mart. And it costs millions to maintain every year. And you see how many spaghettis are there. The core of the problem is the fact that banks have not understood yet the deep digital nature of their core business. What is the core business? It's creating, maintaining, trading, and analyzing financial contracts. That's what they do. So why can we call financial contracts digital by nature? Financial contracts are, first, pure exchange of cash flows. I give you cash, what do you give me back? Cash. Cash flows are units of account, and units of account can be represented by pure numbers. And the sequence of cash flows, how you pay, are determined by algorithms. There's also some external input via oracles. And the different patterns, there are certain patterns how we exchange cash flows, which are algorithms. They are limited in numbers. This makes financial contracts the prime candidate for smart contracts following the definition of SABO. And I'm referring here of the article in 1996. It seems obvious that the blockchain is the solution for the problem because everybody talks about smart contracts. Is it? Now the term smart contract, based on Szabo's article, has been popularized by Ethereum with the introduction of the programming language Solidity. Solidity is a Turing-complete language, which means it can do what normal programming languages can do today. The link between the programming language and the smart contract has captured the mind of the crypto community to the extent that today any program which you execute on the blockchain is a smart contract. So if you add 1 + 1 and run it on a blockchain, it's smart. So anything what you have then. So, however, SABO defines 1996 4 conditions which are necessary for a contract to be smart. The first is observability. You must observe. The blockchain is good in that. Everybody sees the thing, which conflicts with the last, privity, which means privacy, actually. But observability is given. The second one is verifiability, and the third is enforceability. Of the 4 conditions, the blockchain really fulfills only the first, observability. What is mainly missing is verifiability, which can only be attained with a standardized algorithmic representation of the contracts. Observability in combination then with verifiability maximizes enforceability. Once you have a well-defined contract on algorithms, everybody sees the same thing. No judge can say anymore, you didn't intend to do that, or the limits are very small, so it's enforceable legally. So we conclude, in order to make contracts smart for the financial sector, we must add the verifiability feature, which then will lead to enforceability. I will call such defined smart financial contract, to distinguish from smart contract, SFCs, to distinguish them even more. Okay, what are the additional conditions that make SFCs verifiable? First, it must be open source and open to every actor. Everybody must see it. Secondly, it must be very cleanly written. Obvious to every programmer that there are no backdoors, no tricks in it, very clean. Third, it must be simple input, output. Fourth, it must be thoroughly and continuously tested. And these 4 conditions make it possible that it's been used by many and checked by many, which even makes it more verifiable, because there's no tricks anymore that can be played. The ACTUS standards fulfills these criteria. I happen to be the chairman of the ACTUS Association. So here we have the overview of the ACTUS, the exchange patterns defined by ACTUS. What you see here, and don't go into the detail, but what you see here is 100 minus X% of everything which is out there, and X is very small. In my opinion, 0.123%, something like that. Only the hyper crazy guys are not covered by these type of contracts. So the name ACTUS stands for Algorithmic Contract Type Unified Standard, and the most important letter in the acronym is the A, which stands for algorithm. That's really the new thing, that it is possible to standardize algorithms, not just data. So what do we mean by algorithmic? As we have seen, financial contracts are exchanges of cash flows which follows typical patterns. ACTUS has defined these patterns and standardized it, like you see it here. And they are made available in reference Java code. In other words, ACTUS represents financial contracts as true digital assets, since algorithms truly reside in computer. What we see here are the patterns of exchange found in the world of finance, from simple savings to mortgages, to swaps, to options, to CDOs, and so on. If you go to the website, you will find all explanations. Scroll down, you will have the detail. Behind each acronym is a set of well-defined functions or algorithms, which define the intention of the 2 counterparties how to exchange cash flows. The most astounding feature is the small number. It's a relatively small number. It's not overwhelmingly large. Normal bank, however, runs on 4, 5, or 6 patterns. That's the standard patterns. Blockchain, as its current state, is mainly focusing on moving tokens from A to B. A moving token from A to B, be it even a cryptocurrency, it's really a fringe activity of finance. Finance is really making and producing financial contracts. However, blockchains, they are now advancing slowly of what I would call finance. They give some loans, there are some futures and things like that. And the simple one, which they are approaching one, is what we call here the PAM. PAM stands for Principal at Maturity. Like every bond, money out, money back, and some interest in between. This alone is already a huge challenge, if you really go into that. If DeFi wants to go on, for example, doing mortgages, and this is a little bit more complex mortgage with rate reset, capitalization, and I don't know what, then you have pictures like that. And that's only two. We are talking here of 3 dozen patterns here. And what you see on the right side, this is rock bottom of finance. Everything in finance derives from these numbers. Whatever you do, whether you transact the thing, whether you buy or sell it, whether you evaluate it, whether you do risk management, everything derives from that. So these are all contracts. To get a full balance sheet yet, if you are not in the financial world, you have to add a few, 1, 2 more contracts for the operational side. Charlie will talk about that. If you want to understand more, go to the website. And you see the address up there. On the left bottom, you see the taxonomy. That's what I just showed you. Then you have the data dictionary there, and there are only about 120 fields. It's like nothing if you compare that to the complexities in the banks. Then you have the technical specification there. I don't think it's a night reading. You have to dig in. You have a demo app there. You can input data. You will see the cash flows here. And finally, you can download it from GitHub, the Java code. Everything there. If you're interested to go even further, here are some things to read. I guess the slides will be out. So, yes. So now Charlie Hoffman, the father of XBRL, will come, and he will show what you can do in terms of accounting with that basis. Then after him, Alan will come, and he will show how regulation can be improved drastically. These are just 2 examples. It's endless what we can do. Thank you. Oh. I'm just serious. I know, I always...
No problem, Willi.
Okay,
I feel like he's
sorry.
doing my job for me. This is quite nice. Feel free to just announce the program. It's excellent. So thank you so much for kicking it off with a bang. As he already teased, I'm quite happy to welcome Charles Hoffman next on the stage. As already announced, he'll be taking a closer look at reporting mechanisms. Fun fact, he is widely regarded as the quote-unquote father of XBRL. For those who don't know what that is, I had to Google it. It's the Extensible Business Reporting Language, which is a global standard for the communication of business information. So I think there are a couple of accountants, etc., that are quite excited to see him on stage. He has, of course, dedicated himself to helping professional accountants and IT professionals really understand and leverage XBRL for digital financial reporting, and looking forward to hearing how that connects to the blockchain space. Join me in welcoming Charles Hoffman.
Thank you. So you gave a quarter of my presentation already. So good afternoon. My name's Charlie Hoffman. I'm a certified public accountant, and I started my career in accounting with Pricewaterhouse as an auditor. And I am credited with being the father of XBRL. You can call me Dad if you'd like. And I'll get into that in a little bit more. So, stating the obvious, as you know, we are in the midst of a great upheaval. There's a great book that explains this. It's a really good book, worth reading. We're going through a transformation from an industrial analog economy to a digital, or to a knowledge digital economy. And my contribution to that digitization is digital financial reporting. So XBRL, the Extensible Business Reporting Language, was created about 20 years ago, and it's been maturing. It's a technical syntax. It's an industry standard. There are about 50 to 60 jurisdictions around the world that use XBRL, about 180 different projects by regulators and others. There are millions of financial reports that are created in XBRL. Examples are in the US, the Securities and Exchange Commission. All the public companies have to report in XBRL. They've been doing that for 10 years. The ESMA just started. They were going to start earlier. The European Single Market Authority. They were delayed a little bit by COVID. The Japan Financial Services Agency, they've been using XBRL, I think, about 10 years. And so basically, I think most public companies, but there are millions of companies that use XBRL for reporting. So, Auditchain. I ran across Auditchain, we ran across each other a number of years ago, and from the very beginning, we saw synergy between what we were each doing. And we recognized that doing these things together was going to help us both. So Auditchain, or the real legal name is Auditchain Labs AG out of Zug, Switzerland. They have a Web3 platform. We believe it's the world's first platform for accounting, reporting, auditing, and analysis that exists. And Auditchain is going after a $600 billion accounting and professional services market globally. And I am a project manager for a project we're just finishing and another project that we're just starting, Pacioli, which is an application that runs within the Web3 application, the Web3 platform. It is a logic engine that pulls a lot of the pieces together. It's an important piece of the puzzle that makes these things work. And basically what I'm after is, and what Auditchain is after, is what I call enhanced digital financial reporting that is enterprise level quality, but it can be used for larger companies, smaller companies, but it's truly digital financial reporting. It's not a regulatory mandate. So some of Auditchain's capabilities. So the Auditchain protocol was deployed November 2021 on the Polygon Mumbai testnet. It is a decentralized architecture. The audit token was listed March 2022. It's listed. You can buy it on Bittrex and Bitmart. One of the most interesting things that Auditchain has done is created NFTs, or what they call process control NFTs, which we believe is the first real use or serious use of NFTs beyond digital artwork. And we think NFTs are far beyond the capabilities that they're being used at right now. We use these to represent accounting and reporting and other process rules. Another thing that I'm very interested in related to Auditchain is their gamified incentive model. It allows all these pieces to be put together into a system that is truly a new way of doing financial reporting. So this offers unprecedented opportunities for automation, coordination, trust, efficiencies, audit trail, stuff that accountants care about. So tying this to what Willi is talking about, he's focusing on financial contracts. To expand that a little bit, I'm also interested in operational or trade contracts, which fills out the full set of things that accountants call transactions, or they're really business events that are recorded as transactions. And basically what Willi and I have both done is taken and found the logical patterns and documented those patterns, and that allows us to create these digital artifacts where we can automate the stuff that we're talking about. So these patterns, there are issues with doing this. Technical people have idiosyncrasies in terms of the way that they prefer to implement things using, one technical syntax versus another technical syntax. Business people have idiosyncrasies in how the terms that they use to describe these things that we're trying to work with and automate. And different areas of knowledge have incomplete understanding of their actual area of knowledge, so digitizing these can make them very difficult. But standards is a way to help overcome these idiosyncrasies, and XBRL is one of those standards that helps to make these processes actually implementable. So what Auditchain is doing is melding all of this stuff together in, my objective is the general purpose financial report being basically created in different ways. We're creating, the second project I'm working on at Auditchain is I'm a product manager for an expert system for creating financial reports. A financial report is nothing more than the aggregation of the financial contracts and the other operating contracts in the form of an aggregated grouping, which is the financial report. So you can see all this stuff in action soon. On June 8th, Auditchain protocol is being deployed on the mainnet at the Digital Accountancy Show in Tottenham Hotspur Stadium in London in front of 2,000 accountants, auditors, and regulators. So here's the way that I like to help people understand the magnitude of what I'm talking about. So think of the ISO shipping container, the standard ISO shipping container, and think about the impact that shipping container standard has had on global trade, on the way that ships are built, on the way that trains are built and operated, the way that trucks are constructed, and the interaction, and how much, it's just, that's the kind of an impact we're going to have here with the things that we're talking about, Willi and myself and Auditchain. So that's it. Thank you very much.
Thank you so much, Charles. I'm sincerely hoping for an invite to the Super Bowl of accountants and auditors inside the stadium. Next up, I'm pleased to introduce Alan Mendelowitz. He's the president of the ACTUS Financial Research Foundation, an organization you should be well acquainted with if you paid attention during the first presentation, which I hope you did. However, he's also held a number of senior positions in the US federal government, including chairman and member of the board of directors of the Federal Housing Finance Board during both the Clinton and Bush administration. Alan, I leave it to you.
Okay, thank you very much. First thing is, can you hear me in the back of one project? If you can, raise your hand. So does that mean nobody in the back can hear
There
me?
we go.
Okay, good. Second, those of you who know the United States, the custom is when you're giving a talk, the first thing you have to do is tell a joke. The time allotted doesn't permit that, so in my best economics speak, just assume I told a joke. Okay, so here we go. That should be the second slide, which is a slide that lays out basically the points I want to focus on. Oops, did I go back? No? Okay, good. These things aren't coming apart. Okay, basically, these are the topics that I want to cover. One is the verities of being a financial regulator. Namely, what's it like really life-wise to be a regulator? Secondly, the problem we face. The third is effective regulation requires a solution, and that is more than what has been done in the reforms post the 2008 crisis. There is a central role to be played, I think, in transforming data, and that involves not just smart financial contracts on the blockchain, but the role that smart financial contracts can play in transforming data. And then the last, of course, is amazingly, everyone can benefit from this transformed data. So these are the verities of a regulator's life. The first is there will always be another crisis. If you think there won't be, you will be fooled because there will be. And if you're around long enough, you'll be fooled again. Secondly, I guarantee you the cause of the next crisis will be different than the cause of the most recent one. However, the transmission mechanism, which mainly comes down to the cash flows, the expected cash flows between all the important nodes in the financial markets. That remains the central transmission mechanism. Liquidity, expected cash flows, that is always the trigger of a crisis, irrespective of the true fundamental underlying reason for the crisis. And then lastly, regulators have in fact made improvements, but support for what's really needed has not advanced sufficiently to place regulators in the future if there's a crisis. Again, we're going to be, unless something is done, we're going to be caught in the same bind that we were in 2008. You know, I got to tell you, when the 2008 crisis came and it blew up, nobody knew what was going on. Not the Secretary of the Treasury, not the Chairman of the Federal Reserve Board, and Ben Bernanke, who was the chairman at the time, was the authority on the Great Depression. You would have think he saw something coming. Not the regulators, not the CEOs of the great institutions, the great financial banks, the great investment banks. In fact, Jamie Dimon, everybody says is the CEO who's closest to the data. He didn't know any more than anyone else. And once the crisis hits, it is too late to collect the data you need to understand what's going on. You either have the information at the moment the crisis breaks or before the crisis breaks, or you're going to be flying blind, just as everyone was in 2008. If anyone's picked up Hank Paulson's biography or autobiography or his report on the Great Crisis, he tells the world that he basically was sick to his stomach and panicked and in great fear because everything was falling apart and he didn't know what was going on or how to stop it. So what are the problems with the data? The data tends to be backwards looking and risks are in the future. The data is static, and if you want to really try to anticipate a crisis, you got to be forward looking. The data aren't current. Like as a regulator, we would get monthly call reports with accounting data about the condition of the banks we regulate. But between when the data got reported, which was 6 weeks after the date certain they applied to, and the next 6 weeks that were required to cleanse the data and reconcile the data. The first time you could even begin to look at the data was 3 months old. And in the world of finance, 3 months is an eternity. For example, in the middle of July 2008, a regulator, Fannie Mae and Freddie Mac, issued a report that said Fannie Mae and Freddie Mac were well capitalized. And 6 weeks later, they were in conservatorship because they were insolvent. So current information is absolutely essential if you're going to do it. And so basically, we have to collect financial contract data that permits the forward-looking cash flow analysis. And you also need this not just for understanding the condition of individual businesses, but you need this to understand the linkages within the market, because the linkages among the important nodes on the financial system are always the cash flow obligations between them. This one is the solution lies in understanding what kind of data enables forward-looking analysis. I'm not going to talk about this, just refer back to Willi Brammertz's presentation because it just summarizes his main points. And if you go, the role of smart financial contracts, I think, are essential if finance is to be brought to the blockchain. Namely, just making a payment on the blockchain isn't finance. Finance in the debt world is entering into long-term multi-payment contracts between contracting parties. And so far, that has not been realized on the blockchain, and the great challenge is to find a way to do it. However, just to say have a smart contract isn't the best solution, because if you consider every contract to be bespoke, you're going to wind up with programming mistakes, things creeping in, disputes over what the contracts mean. So the computational core for a viable, smart financial contract has to be a validated, tested, widely accepted, algorithmic financial contract standard, namely the ACTUS standard. And with such smart contracts, You can take the granular transaction and position data, and you can enable the transformation of regulatory data collection. You know, basically, with the way a smart financial contract built around an ACTUS, an ACTUS computational core, and now enables robust stress testing, capital adequacy, liquidity coverage assessments, solvency regulation, reporting, aggregation, recovery, and resolution. And for the first time, absolutely for the first time, you can do systemic risk exposure analysis and understand the potential for contagion and cascading of failures, because you can see the cash flow linkages between the major nodes in the financial system. So the beauty of this is this doesn't have to be done in a way that costs anybody any money, because there are so many problems in the financial sector that can be solved with the adoption of a financial contract standard such as ACTUS, is that everybody benefits. Everybody benefits. You know, if you're a consumer, you get a better understanding of what kind of agreements you're entering into. You can enhance your financial markets, and we can enhance transparency and inclusion in the financial markets. If you're a bank, you can significantly improve the efficiency of your operations and reduce all the costs and waste associated with things like the constant effort to reconcile through all the multiple systems in your bank the analytical results that you're trying to get. And from the perspective of the regulator, you're actually able to do something that could never be done before. Smart financial contracts around an algorithmic contract standard, ACTUS. You, for the first time, have contract information, contract data in a standard that permits timely, frequent, and easily understandable and comparable assessments of the condition of regulated financial institutions, plus, for the first time, a clear understanding of what the linkages in the financial network consist of and what the potential risks are for cascading failures, and maybe even see in advance or sufficiently in advance an emerging crisis. So at a minimum, instead of a full-blown crisis, you just get a mini crisis. Thank you.
Thank you, Alan.
They not only called me to moderate because of my involvement in finance and blockchain, but also because I'm Greek, and maybe what we've been talking about is Greek to you, so I'll try to be a translator, right? I will try to be on time and keep some time for questions from the audience. There's so much that we could talk about. I think that the biggest basic message here is the importance of standards and the network effects that can be unlocked by adopting the right standards, because obviously we have all sorts of standards in place. They're not harmonized, they're not the right standards. So, Charlie, you are the person that understands this very well. Can you give us another example of these network effects that can be unlocked if we adopt the right standard?
Cell phones. How many people here have used cell phones 20 years ago or 30 years ago when they had, I don't know how it worked, but I know that they had some cell phones now, the Apple has SIM cards. And that was one of the standards that it was used in Europe. In the United States, they didn't use SIM cards, or some people did not use SIM cards. You couldn't take a phone from the United States and use it in Europe. Japan had their own standards. And it's now I think it was Apple that pushed the SIM card, and now we have one cell phone standard. The really weird piece that I don't understand is you have AT&T cell towers, Verizon cell towers, T-Mobile cell towers, and other cell towers, all in the same area, and So basically, the cost of cell towers is however many providers there are times what it costs to put up a cell tower. So why is it the case that we don't have one cell tower that all the cell phone providers use? So all these are business decisions that people make to basically try and keep the consumers paying for as much of this stuff as possible so they can make as much money as possible. But standards and being efficient helps to push this stuff, the cost down to the consumer. But there's countless examples of standards. Electrical plugs.
And with your examples, we also recognize the importance of open source technology being used at that layer of the standardization. Which brings me to a very basic question. I mean, we do have standards. So what's different about ACTUS? What is unique or the differentiator from all the existing standards? Maybe Alan will,
Sure. No, I think when you think about standards, the most important question is, what does that standard make possible? When it comes to standards for processing commercial food, hopefully what it makes possible is the standards for handling that food deliver food to the table that in fact will nourish you and not make you sick. If you look at the standards that have been around with respect to finance, they have not been standards that supported analysis, as we understand what modern financial analysis is. Modern financial analysis starts with expected cash flow, or I would even take a step backward. Modern financial analysis starts with promised cash flows, what's embedded in the contracts, what you're supposed to pay and when you're supposed to pay it. And then you apply risk models, if you're doing forward-looking analysis, to understand what the expected cash flows are. Namely, the world isn't perfect. Not every contract is going to meet its obligations. And so the expected cash flows give you insight into what the impact of risk is with respect to lending money under the terms of a financial contract. And once you understand that financial analysis starts with cash flow, and then you look at where it is applied, you then begin to see the importance of the ACTUS standard and what makes the ACTUS standard so singular. And that is, if you are in a business, in a financial business, if you're a bank, if you're lending money, a contract expressed in the ACTUS standard can be used in every function of a bank that relates to the determination of what a contract requires in the way of payments. And that means you can use the same algorithmic contract representation in transaction processing, where the bank determines every day who it has to pay and how much, and who it expects to receive money from and how much. It can be used by the chief risk officer to do risk assessments. It can be used in the treasury function to understand liquidity and asset management. It can be used in forward business planning, and it can be used in pre-trade analysis to help in understanding what products you want to bid on and what products you don't want to bid on. And so I think that's the most important thing to bring to the table, that this is something that's really important for the operation of a financial institution in a very efficient way. Anyone who's examined the way current legacy banks operate understand the tremendous efficiency, inefficiency, and costs associated with the myriad different systems they have that don't simplify and represent contracts in the same standardized way. And this, what is interesting enough, I think, is a threat to the legacy systems. If the fintech world is going to come up with a more efficient solution, the legacy institutions are going to have to find ways to cut their costs. And the most efficient way to do it, the best way to do it, is to rationalize how they represent their data, their financial contracts. And that's even before you get into the importance of what you get out of the standard in the form of better regulation.
I mean, what I'm hearing, go
No,
ahead. Will.
maybe I would say the same, but in some other words. Today's standards in finance, they're all about standardizing attributes. You know, what does nominal value mean, what maturity date means, and so on. And these attributes have no meaning unless in the algorithm. The meaning is what you do with it. Actually, they are input parameters to functions. And what we standardize are those functions in combinations to the initial state. That makes it unique. Nobody else thinks there was even no thinking that we could do that. And so ACTUS does that.
It's what you guys, I heard from you, making this distinction between digitizing data, and you are digitizing data in context.
Information.
Information,
Yes.
which is not done elsewhere.
Exactly.
Correct.
That's what I understand. The other question that I have is the big problem that we currently have is we do risk analysis with all these limitations, and each institution, be it a big bank, a big insurer, does it for itself. Mm-hmm. But then, of course, there's an aggregate picture of the whole ecosystem and how it's connected, and we can't have that picture. It might take us 3 months. We all know that from the crisis.
You can't do it in 3 months. You can't do it unless there is a transformation in the data.
Is this something that the ACTUS layer sort of is proposing that it can be done if the ACTUS layer 1 is adopted?
Absolutely. Remember, a lot of the data that the regulators collect is aggregate data. You lose information. Some of the data consists of statistics, like duration of equity. They have limited applicability, and you lose a lot of information. The regulatory community does not collect granular transaction and position data in a proven standard like ACTUS, which would allow them to not only do current and forward-looking analysis for individual financial institutions that they regulate, but they could see absolutely clearly what the cash flow obligations are between the different nodes on the market. And that is the first step in understanding the risks of cascading failures in a crisis. I mean, I'll give you an example. When anybody remember the long-term capital collapse? Okay. I was going to say, you all look too young. But I had a friend who was at Goldman Sachs at the time of long-term capital was going down. And the New York Fed invited all the investment banks in, sat them down around a table, and they said, this is what, Lehman Brothers, you're going to pay this. Goldman Sachs, you're going to pay that. Solomon Brothers, you're going to pay this. And the representative of Goldman went back to meet with his senior leadership team, and he said, and these are representative numbers, because I don't remember the exact numbers any longer, so don't quote the specific numbers. So he goes back and says, well, the Fed said we got to cough up $150 million to keep long-term capital from collapsing. And one of the senior leaders put up his hand and said, look, our exposure to long-term capital is $100 million. In what world does it make sense to put $150 million at risk to protect $100 million? And the response was very simple. He says, you're right. If the only thing that would happen is long-term capital went down, we would lose $100 million. We wouldn't like it, but it wouldn't put us in the tank. The problem is we don't know what anyone else's exposure is to long-term capital. And if, for example, Merrill Lynch's exposure to long-term capital was large enough to throw Merrill Lynch into bankruptcy, we could not sustain the losses on long-term capital and Merrill Lynch, and we would go down too. Only a regulator who fully understands, the regulator can be the only one who can collect the data to fully understand what this kind of interconnectedness is in the market and what kind of risks of cascading failures are there. Up till now, every time those decisions were being made, they were really being made blind. In March of 2008, Bear Stearns got into trouble, so the federal regulators orchestrated a takeover and bailout of Bear Stearns. 6 months later, Lehman Brothers got into trouble, and they didn't successfully find a merger partner. The feds weren't prepared to do what they had to do to save Lehman. Lehman went down, and the whole world went into the tank. I mean, if you don't appreciate how serious the 2008 crisis was, if the U.S. Fed had not used every shred of legal authority and every innovative use of resources, we would have had a second Great Depression. And so that's the kind of stuff we have to avoid. And the only way to avoid it is to really understand what the risks are. And the only way to understand the risks is if you collect the granular data that identifies counterparties and the cash flow obligations, and then you aggregate up from each institution who owes whom what, and then you can stress the whole system and see, in fact, where the risk of failures are, and, for example, as a regulator, require members to take steps that reduce that risk.
Very interesting. You spoke about the smart financial contracts. What's the acronym you use?
SFC.
SFC, another acronym. So how does that differ from what we all use as an umbrella term, the smart contracts in the blockchain space?
The main difference is that meanwhile every program executed on a blockchain is a smart contract. So that's the smartness, which does not cover those 4 conditions for a contract. That's the difference. It's verifiability which is really missing, and verifiability needs this correct understanding of the contract. A standard, open source, published, tested.
Okay. Okay. So you mentioned that privacy is also part of that. So how does that come in to the SFCs?
Yeah. No, that's not covered by the SFCs.
Okay.
That must be done by the blockchains in addition. I think that's another big hole to be covered.
Okay, got it. And how about all this architecture that you are proposing? How does it promote or support, if you want, financial inclusion?
Yeah, in a world where ACTUS is really through, I imagine pupils from 8th, 7th, 8th grades will learn about financial contracts. Then, financial illiteracy is normally considered a problem worldwide, even in Switzerland, where I think we are all, pretty high. So that's a real problem. I see it's possible because it's so logic. But you have to start at the right starting point. It's like ABC almost. So they learn the ABC in grade 8, 9, and I believe that everybody, as uninterested, you will have on your mobile, you will say, oh, my cash flow obligations are so much, because from every bank's independent where the data is, you can read the data, you can see your cash flows, you can aggregate, you can value them, you can do whatever you want. There will be apps for that. And that will make it very easy for banks in Africa even. They take the standard. Actually, there will be standard representation of the paper contract. There's the ACTUS in the background. There's some paperwork which refers to that. A very easy download, make a contract. So you only have to focus on the essential. Is the guy paying back or not? And these kind of things need to be done.
So really you're proposing this layer 1 protocol that will enable all these other functions around transparency and personal financial management, and then at the B2B level and so on. Where are we, Charles, in terms of the adoption? You spoke about digital reporting.
I don't really know how to quantify it. It's going very well. It went. People were astonished when the U.S. Securities and Exchange Commission adopted XBRL in, I think they decided in 2005, and people were kind of astonished because usually it takes a lot longer to adopt a standard like that. But others are following the SEC's lead, and all around the world, nobody really says that it's not a good idea. But in my view, one of the things that has to get better is business people have to learn how computers really work and learn to talk to IT people
in business
better.
language.
There needs to be real communication between business people and IT people. It's a huge problem, and the communications it causes a lot of failure in IT type projects, and it hurts the business people because they can't leverage these really good tools because they don't accept the technology, they don't understand the technology, they don't take the time to learn about what you can actually do to it. And this is going to be, it's not a problem just for the finance industry. It's a problem with driverless cars. So who do you think makes rules for driverless cars today? Programmers. Do you really want programmers making decisions about how these cars behave when you have a situation like using an example that might come up in a philosophy class? If this person is going to die, the pedestrian or the driver of the car is going to die, who's going to make the decision? That kind of a decision. And those are real decisions that have to be made and literally programmed into cars. And it's going to get more important because there's more and more things that we're going to try and get artificial intelligence to do for us. And a really good example is the whole nuclear war thing, and whether you take humans totally out of the loop and let them decide whether the nuclear bombs go off, or whether you want to have a human in there that can make a mistake. So I don't know the right answer, but humanity is going to have to decide, and these are going to be really tough decisions, and it's really important to have the right background knowledge to make the decisions appropriately so that we get the world that we want.
Very interesting, because here we're talking about even if we have the most suitable technology, and especially at these layers where we are setting standards, hoping for network effects and so on, if the people in the business don't understand it and don't adopt it, then we'll never get there, and we'll be facing that more and more. Is what you're saying?
Yeah, and maybe I may add. At the moment, that's not there yet, but the plan is, we just discussed this morning, to use ACTUS as the basis from even XBRL, which gives a very clear-cut understanding about the financial contract, at least those. There's more than that. So from there, everything will roll up and will make many things much simpler than what Charlie just mentioned here. And I want to add yet, the XBRL standard is in 60 countries standard, so you have to report in. So it's a pretty important standard, I would say.
In 60 countries in terms of financial reporting, or for other uses too?
I don't really know the correct answer, but I think it's mostly for financial reporting. There's a lot that's used for tax reporting in the Netherlands and in Australia. But financial reporting is so easy to automate because it's a mathematical model. It is literally a mathematical model. And most accountants don't understand that. They don't realize that the double entry bookkeeping model that is the foundation for all this stuff it's math. And it's not sophisticated math. It's like a little bit more complicated than arithmetic.
If I ask you all, we're going to shoot a documentary or a movie, and it's going to be XBRL meets blockchain. And what happens? You know, what is this love affair about, and what is born through this? Because this is what I'm hearing from you. I know XBRL, you know, in a silo sort of
I
state.
can answer that question.
Yeah.
So, first of all, accounting and blockchain are a match made in heaven. So accounting is about ledgers. And, you know, people know about most people know what a ledger is. It's just a list. Double entry accounting it's just two lists. It's have this list, and you compare these two lists, and that makes it so you can detect errors and prevent fraud. So with triple entry accounting, you have another list that's potentially out on in a public ledger, so that you can corroborate information. Like a company can say they had a transaction, and another company can say they had a transaction. But today, if they don't match, somebody can get away with a fraudulent transaction or something. But with the blockchain, it's really hard to lie because you can verify things because of these digital ledgers. But accounting it can be a really mechanical, boring, even grotesque job if all you're doing all day is moving numbers from one cell in an Excel spreadsheet to another cell in an Excel spreadsheet. I don't really like that. I think there are far more interesting things to do. And I think that what's going to happen is that these technologies, after people, they understand how to use them and they understand how to get them to do the things that they want them to do, they're going to find it very useful, and jobs will be eliminated, but they're going to be jobs that nobody really wants to do because they're not very interesting, they're mechanical, they're repetitive.
And they would shift into the insights and the visualizations.
Accountants will be able to do more analysis. I mean, they've got very good skills in those areas. That's what they go to school for. But when you actually go out in the real world, you're copying and pasting stuff from one Excel spreadsheet to another far too much.
I mean, the topic of early warnings in a financial system, or I mean, in the economy in general, right, cannot be underestimated. So where are we at today, Alan and Will, in terms of these early warning systems? Have you been piloting something with the ACTUS and an audit chain? Where are we at? Because I understand from fintech and traditional understanding that nothing has changed since 2008.
I think the issue of what's changed and what hasn't changed is important, because there were important, I think, reforms. Doing stress tests were good because it gives the regulator an indication of what's going to break a bank, you know, a large, important bank. You give them 3 stress scenarios, they run them, and they spend months and months doing it. They come back, and if they pass the 3 stress scenarios and the regulator says, good, we like that. And then recently the regulators came up with a liquidity coverage ratio. This is the first time regulators really stepped up and started focusing on liquidity, which is amazing given the fact that all crises get triggered by liquidity or illiquidity. And so this is good. But for example, the way they came up with a liquidity coverage ratio was tied to the fact that they only had access to very limited data. They didn't have access to the granular day-by-day liquidity flows in an institution. So given the limitations of the data, they did what they could. And I think that if we want to really change the world, you know, I love fintech because fintech is going to change the world and make the world better. Lots of idealistic goals and objectives. If we're really going to do that, if we're going to make the system more visible when it comes to risk to the regulators, both for individual financial institutions as well as the system, if we're going to try to get a hold of that, if we want to be able to look at liquidity and we want to be able to look at capital adequacy, if we want to look at asset liability management, take your pick. In order to do that in a real time by a regulator, there is only one set of information that makes that possible, and that is the ongoing collection of granular transaction and position data in the ACTUS standard, because then they have the starting point for all the analysis that needs to be done for an individual institution as well as for the system. And so I think the reforms that have been made are improvements, but we have to do a lot more to get to where we need to get so that when the next crisis hits, we're not going to be flying blind again like we did in 2008.
Yeah.
Maybe to add here, we are in discussion with regulators. He himself is the next regulator, with BIS, with the ECB, SNB, in the FDIC and so on. So there's awareness, but it's of course slow. But what is also very encouraging, we have a National Science Foundation project here in Switzerland of University of Zurich and Winterthur and Lucerne, where they want to, the task of that project is to prove the regulator that regulation will be, the quality of regulation will increase dramatically with ACTUS. So there's a project on the way where it really will be presented to them.
The vision to get as if we are on board Star Trek and the regulator can see everything.
Yeah.
It should only be as sexy as Star Trek.
There's a question.
So yes, questions, please. We have 5 minutes.
There's another one here.
Go ahead.
You're mentioning always standards. Standard is for me a little bit the word of... Hi. You are mentioning a couple of times standards, and this is for me a little bit something out of the old world. I became a blockchain enthusiast of decentralization, not one power, to have really a flexible ecosystem. And I'm believing in bridges instead of standardization, so bridges between all the different projects. You mentioned the SIM card. I'm happy that I have not only a SIM card in my mobile phone, that I can call also via WhatsApp and other things. And I didn't elected the regulators in my world. They're very powerful, but even Lehman Brothers went down via the regulators or in face of the regulators, and Bitcoin went up and down without any regulators. So I don't see an advantage to always look to regulators instead of taking our decentralized mission on full and build bridges.
I can give you a good example of a decentralized system. It's the first example, spaghetti. That's exactly where even with a single bank, it's impossible to understand what you have. And even the blockchains, they rely on standards. Otherwise, it doesn't work. You know, even the decentralized has very centralized pieces in it. That's the first. And secondly, this system is not made for regulators. It has a big impact for regulators as well. It's made for finance. And it's like in his last picture, actually those who profit more are the financial actors, the banks, or even the blockchains, then the customers, and then finally the regulator. That's how I would put it.
Hi. My question is, a summary to my question is, I'm still paying for Lehman Brothers so that they can find out what happened and to trace recourse. when I witnessed my first when I had my first full understanding of decentralized finance, and I witnessed kids assembling components on a blockchain, securitizing them, and making a market on Uniswap, all before their first bowl of cereal. And then, with a single click, unwinding that securitization and reverting all of those counterparties and values back to their original locations. How, Willi and Alan, what is your attitude toward what has happened? This is not happening, it has happened already. And it's only going to get more complex, more transparent, and more functional and usable by business people. If kids can do it, we can do it. What's your attitude toward the ability to unwind a CDO having 10,000 components? How do you respond to that?
Look, Jason, the first point I would make is that look at the capitalization and exposure of the legacy world, and then look at the capitalization and exposure of the DeFi world. As long as we're going to have fractional reserve banking, and it's going to play a major role in the economy, you can't leave them unregulated because they're going to blow up. It's guaranteed. Secondly, in the DeFi world, one of the barriers to expansion is volatility in the cryptocurrency. Blockchain lost 40% of its value in the past few months. And that represents foreign exchange risk that most people consider intolerable. And so the solution was stablecoin. And yet there are different approaches to stablecoin. One approach is to back it with funds. If you back it 100% with funds, I don't understand the economics of it. You might as well just use, francs or dollars. If, on the other hand, you back it only partially, you're back to fractional reserve banking, and you got something that's going to explode. And if you try to use algorithms, you wind up with TDR? I can't remember the Treasury digital currency. So the answer is, it's the goals of DeFi are absolutely impeccable. The passion is absolutely impeccable. But the path forward, as far as I can see, based on what happens and what's been going on, is not a clear, untroubled path forward. I think the potential for efficiency is great. I think the potential for simplification and improvement of understanding is great. But at the same time, there's enough glitches in the system that those have to be worked out too, one way or the other. I mean, the very notion of an immutable record was broken when, after the Dow ripoff, the ripoff of $50 million from the Dow, Ethereum instituted a fork. And the community split. Part of the community said, no, these are the rules. We don't like what this guy did, but it was in the contract. We can't complain. The other half said, what are you talking about? He just stole $50 million. We got to do something about it. And so DeFi is not in practice an untroubled world. I think it's innovation and revolution that has great promise. But between here and there, we've got to deal with a lot of things. Secondly, as long as the legacy world is a major part, or the major part of the financial world, and given the fact that we know the legacy world is going to blow up, we should be regulating it in the best way possible, because if the legacy world blows up, the DeFi world is going to blow up also. It's not going to escape unscathed because the economic impact will be so broad. And so I would say DeFi has to work on figuring out how to do it better, and the digital and the legacy world needs a transformation in the data that regulators collect from them, so in fact regulators can do a better job of reducing risk to individual institutions and the system as a whole.
I mean,
maybe on the unwinding of the little kit of the 10,000, I don't know what. They only can do it with a standard like ACTUS. Otherwise, it will blow out much earlier then.
Yeah.
I think we have to stop, but I'd like to add in a dream world, maybe the regulators as we have them today are replaced by some governance token, that the holders of that token are different entities and so on, and there's a doubt. Maybe we go there, but still, even in that case, we do have to have some rules, right, to prevent that system. Thank you very much for the wonderful discussion.